Well, Citi is out with a new note telling investors to stay hedged and be patient. Stuart Kaiser is behind the call. He's the firm's head of equity trading strategy. You must have been busy today. What were the incoming calls like?
Yeah, I think it's a lot of what you all discussed. The positive, I guess, or people are trying to ask is it time to buy the dip? So I think that means, to Carter's point, you've pulled back enough where people are kind of answering that question. Our view is no, it is not time to buy that dip, mostly because it has been about the economy. It has been about Trump policy. But in the end, what's really impacted the market is just position destruction. And the stocks that are under pressure are the popular longs, the winners from the last 12 to 18 to 24 months. And those stocks were down more than 5% today. In our measure, they're down over 20% in the last month. And until you see some stability in that part of the market, I wouldn't confidently want to step in and buy the dip here.
When you think about, again, the safety trades, as you were talking about, a lot of folks felt really comfortable in the Mag 7. They felt really comfortable in the banks. Some of the flows that you're seeing, going back to what Mel just asked you, what seems I don't know if I was going to say scary. I don't mean that. But if you think there's lower lows that happen, what do you think leads to the downside here? Is it like financials? Because to me, I'd be more worried about that. At some point, this Mag 7 secular shift as far as, generative, that'll get back on its horse. It needed some froth to come out of it. But the banks kind of worry me here.
Yeah, I think the banks and then the power generation story are two that we've got a close eye on because those are not retail trades. To your point, eventually retail is going to want to own Apple or Meta or Tesla at levels that are 20, in Tesla's case, 50%, below peak. But the banks and power gen, those utilities, I think those are clear institutional trades. So I think one day last week we saw the banks down about 3%, definitely got our attention. A couple of the popular utilities were down double digits last week as well. So I agree, banks and power gen are two from an institutional perspective I keep an eye on. And again, they have not shown the stability in our view that you need to be confident to put capital at risk right now.
So, Stuart, at the institutional level, of course, the individual has choice, free will. You can sell, you can buy, long, short, can you? But the big long onlys, fully invested all the time, not allowed to hold cash. That's the game. And they're playing from the same playbook as always. The S&P Pure Value Index, since the market's peak on the 19th, is down 1.2, whereas the pure growth is down almost 12. You're talking about 1,100 basis points of spread. For those who have to play, what are you saying or recommending in this environment?
Look, I think the growth value also has a lot to do about positioning, also about what's going on in interest rates. I think long onlys have two concerns. Number one is if you look at late January, early February, you got that really bad University of Michigan sentiment print. That kicked off 3 out of 4 weeks with net outflows from ETFs and passive mutual funds. So to your point, long only has to hold, but they've also seen some money being pulled out, which means they've had to contribute as well. Generally speaking, I'd rather be in growth than value here. Logic being that you have three broad outcomes. You have a hard landing. I think growth outperforms value in a hard landing. Higher for longer. I think growth probably outperforms in a higher for longer environment. You really need this immaculate sort of re-acceleration in the economy to get small cap and value working. So just in our view, probability adjusted, you're more likely to be happy in growth than value. But to your point, it has not worked year to date, and I wouldn't blame people for being skeptical.
Stuart, I'm sure there are people sitting around saying, you know what, the market sells off enough, the Fed is going to bail us out like they have over the last 20 or so years, which maybe they will. I don't have a view. But what I will say is we have CPI on Wednesday, and if that were to come in hotter than expected, it backs them into a corner that they're already in. So maybe speak to the importance of the number this Wednesday.
Yeah, I agree with you 100%. I mean, we had talked about earlier in the year, the risk for the Fed is that, if you are cutting government spending at the same time you're introducing tariffs, you create pressure for the Fed on both sides of the dual mandate. So the number is very important. If you remember back to early February, you had UMISH, inflation expectations had ticked up, average hourly earnings had ticked up, and that made that inflation print really, really powerful. We got past that okay. So the Fed will be watching this. They've been very methodical, I think, about communicating that, inflation risk is not a near-term concern. So I think you need a pretty hot print, especially after average hourly earnings got revised down. That said, options markets pricing, 1.4% move on CPI. Markets telling you it's important. To your point, for the Fed, it's important. So it matters. Oddly, and I may never say this again in my career, I think UMISH might be more important than the CPI this week, though.
Are there any levels on the S&P 500 that are sort of witching levels in your view, whether it be levels that you're watching, levels that hedge funds are watching, levels that CTAs are exposed to?
Look, I mean, CTAs are max short across all the U.S. benchmarks right now, which actually, to some degree, you might read as a positive sign that systematic supply has come in. Again, I wouldn't put a number on the level at this point. To me, it's show me those core long positions that are just getting eviscerated. Show me that those have stabilized, and regardless of the level, I think I'd be more positive about kind of re-entering the market. I'm sure the big round numbers will matter. I'm sure there's a technical support level. We're already through the 200-day. That was obviously a big level, which we defeated already. So not a level in particular, but more it's what is going on internal to the market. Do these momentum trades, these tech trades, these sort of hedge fund favorites find their footing or not?